Okay, so we are going to get started with chapter 13, and chapter 13 talks about current liabilities and contingencies. We will be looking at long-term liabilities in chapter 14. So the topics that we will cover here, and this is taken from your SATE course outline, we'll look at the nature and measurement of current liabilities, learn how to account for current liabilities, learn about non-financial liabilities. What on earth do non-financial liabilities mean? And there must be something called financial liabilities by definition then. What the presentation and disclosure requirements are for current and non-financial liabilities, and then do a quick little comparison between IFRS and ASPE. So a liability, the definition of a liability is under IFRS, the definition of a liability is provided in the conceptual framework, okay? So if I was to pull up NOSHA, the standards, if you clicked on part 1 IFRS, and the most recent edition is the 2022 edition, you'll find that under IFRS, the conceptual framework for financial reporting is put outside of the IFRS standards that are currently in effect. I clicked on that conceptual framework. In the conceptual framework, there is chapter 4 that talks about elements of financial statements. And under the elements of financial statements, I can find the definition of a liability. If I clicked on definition of a liability, the definition of a liability as per the IFRS conceptual framework is, and I hope that this is showing up on your screen. Are you able to see the screen or? Yeah, okay.
Yeah.
So on your screen, you'll see here, paragraph 26 says, a liability is a present obligation of the entity to transfer an economic resource as a result of past event. That's basically what IFRS says. Now, when you try to tease it out, when you try to break it down, it's a present obligation. So an obligation, something that you got to do. Why do you have to do it? And what do you have to do? It's an obligation. What is the obligation? It's an obligation to transfer an economic resource. So economic resources are assets. So a liability is an obligation to transfer an asset to someone else. And the obligation is a present obligation. We owe that now, not in the future. We owe it now because this obligation exists because of some transaction that we entered into in the past. Some past transaction has caused an obligation for us that we have to discharge in the future through the transfer of assets. That's basically what the formal definition of a liability is. Now, the beauty of it is that this definition is so malleable, like depending on the circumstances, you'll find different liabilities. Like you can actually apply this definition, right? And these conditions are not met, it would not be called a liability. Right? When you actually look at examples, that's basically the definition that we have. So 3 characteristics: we have a duty or responsibility to others, which is the obligation side. We don't have discretion to avoid it. Like we can't say, oh, we're not going to do it. An obligation, it's a duty, responsibility that you have to take care of, right? And then it's as a result of a transaction that has already happened, okay? A transaction that's already occurred in the past. Now, liabilities can be financial or non-financial. A financial liability is simply one under which the company has to pay cash or something else that has cash value. So it's a contractual obligation to deliver cash. Most cases, if you think about liabilities that have the word payable attached to them, accounts payable, notes payable, wages payable, income tax payable. When you see the word payable, we know that we're going to have to pay for it in cash. The financial liabilities, mostly we have to pay cash, but there can be circumstances where instead of paying cash, we could end up transferring some other financial asset. Uh, so, um, and I don't want to get into too many complicated examples. So mostly it is a liability and obligation to deliver cash or to exchange financial assets or other financial liabilities with another company under conditions that are unfavorable to us, right? So the circumstances will be such that we will be at a disadvantage. Our company will be at a disadvantage. If our company were at an advantage, you would think of it as an asset, right? A liability puts us in a slightly disadvantageous position in terms of diminution of our assets, right? Diminution of our cash. Right? Once we discharge, if you have an accounts payable and you pay the other company, your liability will go down, but your cash balance will also go down, right? So that's the way to look at it. A non-financial liability is clearly one that is not a financial liability. What does that mean? We are not going to pay cash. Instead, we'll have to do something else. So the most common example there would be unearned revenue. You might remember that from the past. If a customer pays us money in advance, right? If you got a customer paid a deposit, well, we're not going to return the customer's money. We have to provide the customer with goods and services. That would be a non-financial liability. There are other examples of non-financial liabilities that we'll be looking at as well. Typically, those would be liabilities of uncertain timing or amounts. Um, so any kind of provisions will be non-financial. Is that okay so far? Right?
Yes.
Thank
Yes,
you.
all good.
Thank you. Thank you. Current liabilities. So here the definition is it's from the balance sheet dates point of view. From the date of the balance sheet, if we have a liability that is expected to be settled, and settlement is typically by either paying the cash, transferring the asset, or performing, the service or providing the goods that we are obligated to. So liabilities that are expected to be settled over the entity's normal operating cycle or 12 months from the balance sheet date, whichever is longer. Most companies, again, this can seem very, very convoluted. So think of it. If a liability needs to be paid off within the next 12 months, it's a current liability. Very few companies have an operating cycle that's longer than 12 months. There are some, it could be like if you're a shipbuilder, uh, your operating cycle could be a little longer, right? It could be a year and a half, 2 years as well, but that would be a rarity, right? So that'll be more like an exception. For most part, 12 months is sort of the way you would like to envision it. So if the liability will be settled within 12 months, it's a current liability. There should be no unconditional right to defer settlement for at least 12 months from the SFP date. Now that's important. That the company should not be able to delay settling the liability on its own. Right? Sometimes, that could be the situation that the company has the right unconditional. I mean, there's no other conditions that need to be satisfied. The company can choose to delay having to pay. Well, then it would not be a current liability. There's a third category that could apply here as well, and that is if the liability is held primarily for trading. Now, it's a very rare instance. It's like when you're getting into some kind of options trading, forward contracts, and all. Depending on the way the price movements change, you could have or you maybe did some kind of short selling, right? So if you buy shares of a company, you're investing. But sometimes, you can also do what's called short selling. So you don't own the shares, you actually sell them now because you believe the share price is going to go down. That can create a financial liability, and it's basically with a view to trading. So very esoteric, okay? But it's possible that that can also be a current liability. Most of the current liabilities you're going to see will be the first type, the liabilities that are expected to be settled within the next 12 months or operating cycle, whichever is longer. Now, what are the examples? For most companies, if you have some kind of line of credit or overdraft facility with the bank, they'll show up as a current liability. Accounts payable, right? That's pretty common. You would have seen accounts payable in the past. That would be a current liability. Now, what distinguishes accounts payable from notes payable is that notes payable, they, number one, they tend to be written promises, right? And secondly, notes payable have some kind of interest attached to them. Accounts payable, on the other hand, do not have an element of interest attached. And accounts payable typically are owed to trade suppliers, right? So other parties, so they could be vendors to us or suppliers of services to us. And they're not parties from whom we have borrowed money. If we borrow money for the short run, those would be typically captured in the notes payable section and not accounts payable. You can also have current maturities of long-term debt. So let's say you borrowed money from the bank saying, I'm going to pay off a portion. Say I borrowed $100,000 and I said, every year I'll repay $20,000 of the principal along with any accrued interest. So if I'm going to be paying back $20,000 of the principal every year, then on the date that I prepare the balance sheet, I'll have to report $20,000 of the principal amount as current maturity of the long-term debt. The rest of the money will be shown as a long-term liability. And I'm sure you would have seen something like that in your earlier accounting courses. Sometimes companies have short-term debt, but it's expected to be refinanced, rolled forward, rolled over. So that would typically be a line of credit type thing that yes, you're supposed to pay it down, but then you can kind of get it extended, right? You can borrow the same money again, right? If somebody has a home equity line of credit kind of thing, you borrow money, then you pay back, and then you have the same amount of room to borrow again. You can borrow the same amount of money again, right? So you have something like that. Any kind of debt that gets rolled over will be considered a current liability. If a company is paying dividends, see, dividends need to be declared. They're not automatic. If the board of directors of the company declares a dividend, then the dividends, and assuming that these are cash dividends, the dividends become a liability. The company, once the dividend has been declared, the dividend has to be paid to the shareholder. So it creates a liability. Most companies will have a dividends payable account set up, okay, and it'll be reported as current liability. Any kinds of rent payable, royalties. So royalties would be a big thing in a province like Alberta. Oil and gas companies, they lease the space from farmers and they carry out their activities, their drilling activities, and whatever is the amount of natural resource they extract, they got to pay a certain amount to the farmer as well as a certain amount to the province of Alberta as well, right? So depending on how much of crude oil they pull out or how much of natural gas they're able to generate, there is a formula that they have to calculate the amount that needs to be paid to the government. So that'd be royalty payable, right? Rent payable is pretty simple. Customer advances and deposits, that's a non-financial liability. We talked about it. It's typically unearned revenue until the performance has been completed. We cannot, any kind of advance money that we get from a customer. Now, typically customer accounts, they're maintained in the accounts receivable subledger. But if I have a customer that has paid more than they owe, right, or a customer that has paid money in advance, we cannot offset the credit balance that would be sitting on that particular customer's account name against the rest of the accounts receivable. We have to then separate them out and report the customer balances with a credit balance as a liability, right? As part of deferred revenue or unearned revenue. Cannot offset against accounts receivable. Taxes payable. So that's, for a business, there would be taxes on income, as well as depending on the province, there could be GST, the goods and services tax, or a HST, the harmonized sales tax. In the province of Quebec, you have the QST. Then there you also have PST, provincial sales tax. So you go to Saskatchewan, for example, they have PST. In BC, they have the HST. In Alberta, we only have GST. Um, and the way they operate, GST is and HST are they provide an input tax credit. So the business charges the GST amount from its customers, but any GST that the business pays to buy its goods and services for itself, for its operations, it gets to offset. HST operates on the same principles, but a provincial sales tax works a little bit different. Now, that's got nothing to do with accounting. That's laws that our lawmakers have come up with. So literally, rather than getting lost in the details, if you look at the overall picture, well, if you owe money, if you got to pay money to the government, then it's a liability. And the government is not going to wait for more than 12 months to get the money from you. Hence, it's a current liability. And income tax payable, certainly, the government is not going to give you inordinate length of time to pay the taxes. You're supposed to pay, most businesses are supposed to pay in installments, depending on the turnover the business has. It could be every quarter or even on a monthly basis, right? Businesses have to pay income taxes. So at the end of the year, you'll figure out what your income tax is going to be, and then you square off whatever installments you've paid to set up a net income tax payable liability. Then, of course, businesses have employee-related liabilities. Those would include payroll deductions. All of us that maybe are working, we get from our paycheck. We see there's CPP taken out. There is employment insurance deductions, premiums that are taken out, income taxes withheld. Then you have, for different businesses, they have um, uh, employees may be eligible for getting sick leave or vacation pay. That money needs to be set aside for it. In some cases, businesses will also offer bonuses, some kind of profit sharing. So if you have any of those, if a business has any of those in place, then depending on the circumstances, if the employees have met the conditions for the bonuses, those need to be accrued, and those would represent current liability. I'm not getting into too many details here, just kind of giving you a sense of all those are possible liabilities that we will look at examples, some examples on. Now, decommissioning obligations is not a current liability. So decommissioning is, so if, let's say, an oil and gas company is operating in northern Alberta, once the oil wells run dry, they can't just leave the site and move on. Right? They're not allowed to do that. Although in reality, we do have a lot of abandoned wells, and that's a problem in this province. But as far as the law of the province is concerned, the law of the land says if there is an oil and gas company that is operating a property, where it's pulling out crude oil or natural gas or whatever, once it stops using that particular resource property, the company is supposed to take steps to remediate the land, right? So if there was some kind of hole drilled, that hole needs to be filled up, make sure that it's safe, maybe plant new trees. if there's any kind of damage to the to the soil, take steps to remedy it, right? Bring it back to what its original position situation was, or sometimes companies will go even further and make it better than where how they had found the land. So that doesn't happen overnight, right? If a company starts drilling for an oil well, it's probably going to get oil from it for the next 15, 20 years. But at some point, that well is going to run dry. When it does, the company will have to spend resources, spend money to do the remediation, the decommissioning. It's also called asset retirement, right, in ASPE. So hypothetically, let's say, there's an oil and gas company that starts an oil well and expects that it'll have to pay $10 million in 20 years' time to decommission that oil. What it has to do is calculate the value today, like $20 million or $10 million, sorry, as I said, 20 years from now, is not worth $10 million today, right? Because there's money has time value because of the compounding effect. So you calculate what the value of $10 million is today, right? If you need $10 million 20 years from now, how much is that worth today? You figure that amount, and it'll be much less than 10 million. Say the number comes to 4 million. So what the company will need to do is add the dollar amount, the present value, the $4 million that you calculated, to the cost of the oil well asset, okay, and then depreciated over the life of the asset, as well as set up a liability for decommissioning. So under ASPE, they call it asset retirement obligation, ARO. IFRS, they just use slightly different language. They call it a decommissioning provision. So you set up a decommissioning provision, and then over time, over the 20-year expected period to retiring that oil well, you would need to keep adding interest, right? So keep increasing the liability. So over the 20-year period, from 4 million, the liability needs to keep increasing, snowballing up to the $10 million that we had estimated. So that process is also discussed in chapter 15. And we'll look at an example that'll make more sense. All right. And don't get worried about the details yet. Like, the details are probably not going to stick. You first need just what the basic concept is. So what's a decommissioning obligation? For a company that is in, so we could be a lumber company. So, if we're cutting off trees, we're not going to leave the land, leave the space denuded, right? We'll have to plant new saplings, etc. And say, for whatever reason, if we stop doing operations in a particular geographical area, we can't just leave the land as a wasteland. We have to take steps to make sure that we have, we put the land back in the condition that we found it. It's harder. It's harder. It's easier said and harder to do, since companies could be cutting off trees that took hundreds of years to mature. Now, of course, when the company moves on, the lumber company moves on, it can't leave trees that have already grown to hundreds of years in age, right? But they still need to make sure that they have planted trees that will, over time, grow back to the original pristine condition that they had. Or think about a mining company that's mining for copper or coal or whatever that is. Of course, they're going to be taking stuff out of the earth's crust. Um, Things do happen as a result of the mining. So we can't say that the company will be able to leave the area back in exactly the same shape as it originally was, undisturbed. But to the extent possible, make sure that there's no safety issues, that there's no kind of groundwater contamination, etc. And if there has been, clean it up, right? Clean it up so that there's no ecological sort of impact, long run ecological impact. Um, yes, plant trees, etc. Those are the kinds of things That would be part of the expectation or the legal requirement for asset retirement. We'll also be looking at warranties. All right. So warranties, some of you may have had some experience with warranties, especially let's say if you went to Best Buy or Visions Electronics and you're buying yourself this nice 75-inch TV. It's $3,000, and the person that sells the TV to you tries to convince you to buy warranty on top. The TV comes with a 2-year warranty, but they'll try to say, yeah, this is an important, very expensive purchase, so you can get a 5-year warranty if you paid extra, whatever, $300-400. And the basic idea there is, if something were to happen to that TV after beyond the 2-year manufacturer's warranty that it comes with, then Visions Electronics will take steps to either get that TV fixed for you, or if it cannot be fixed, then they would replace it. Right? So it's kind of an assurance of a product's or a particular product's usability over the prescribed length of time. So in terms of warranties, some warranties they come naturally attached. So in the example of the TV, the 2-year warranty, that if you buy the TV today, it comes with a 2-year manufacturer's warranty. Well, that's an assurance type warranty. But if you were to buy an extended 5-year warranty from Best Buy, it would typically not be, so say you bought an LG TV, LG will give you the 2-year warranty, right? So the 2-year warranty that comes with the TV is a warranty that LG provides. If you went with an extended 5-year warranty, for years 3, 4, and 5, the warranty is actually provided by Visions Electronics or some other company that's partnering with Visions or Best Buy. Right? So for that's a service type warranty. And the treatment in terms of how we account for it differs. Okay, so we're going to see a difference in our accounting, whereas for an assurance type warranty, we do not record a separate performance obligation. Now, some of you will remember this jargon from Intermediate 1 in the revenue recognition chapter, chapter 6. You learned about IFRS 15, the 5-step revenue recognition process. One of the first things, identify the contract, and then number 2 was identify the performance obligations. So an assurance type warranty, the warranty is not considered a separate performance obligation. Now, if it was a separate obligation, you would need to allocate the transaction price to the different performance obligations. An assurance type warranty, you don't have to worry about it. But if it was a separate extended warranty, a service type warranty, then you do consider it a separate performance obligation. You have to split the transaction price, and then there is a separate revenue recognition trigger for it. We'll look at an example for it. Obligations under customer programs. So you can have customer loyalty programs. That's typical examples. If you collect points like PC points, if you shop at the superstore, you get PC points from doing your shopping there. And then after you accumulate certain number of points, you can then use them to get basically money taken off your bill, right? 10,000 points is equal to $10 and whatnot. So that's a customer loyalty. Other examples could be air miles, and there's just so many of them out there. Right? So under IFRS 15, they are seen as a separate performance obligation. So when let's say if I went and filled up my tank, gas at the, they have the gas stations at Superstore, the mobile gas station. So if I use my my PC card to pay, I get, for every liter that I get 7 points or something like that, right? 7 cents. And yeah, 70 points, something like that. Now, when they record the sale, they don't record sale of fuel for the amount of fuel that I purchased. So just hypothetically, let's say I filled up my gas tank for 50 liters and can't imagine how much it would be. Say I paid $80 to get 50 liters of fuel. And by buying 50 liters of fuel, I also got 70 points times 50. So that's 3,500 points, right? So that is supposed to be worth $3.50, right? So in terms of their quote unquote value, it's $3.50 worth of PC points that I get um, based on the transaction. So what they will do is they do not record revenue for the entire $80 of gas that I bought. They split the revenue into the sale of the gas, and then also they set up a liability for the PC point. It's later when I use my PC points at the superstore, that's when revenue is recognized for those PC points, liability for points. So we'll again look at an example to get a better understanding of it. Um, we don't have in Canada as much of these premiums and rebates, but sometimes you might have seen, oh, if you buy, if you buy this, let's say if you buy this bag or this big box of cereal, it comes with a smaller free item, right? You get, or sometimes it is like you buy two, you get the third one free, that kind of thing. So those are considered premiums, extra items, or sometimes you have these coupons, right? So you get a rebate if you, it used to be the case when I first came to Canada many, many years ago, we used to have, there was a coupon. So when we had our kid, my firstborn, we used to go and buy a lot of diapers, right? So in those diapers, Huggies, diaper boxes, sometimes they would have these coupons that you could mail back and get some money off and all. I have not seen any of that now. The most you could see is if you walk into a Costco and you had an executive member, then you have these. So if you like right now, they have something going on. If you're an executive Costco member, you can get certain, like you can buy coffee, their Kirkland branded coffee, and you can get $10 off if you show them the coupon, right? You scan the coupon and you get a $10 off right there. That'd be an example of a rebate, but that gets applied right away. It's a price adjustment that happens right away. So nothing really in today's day and age that would be akin to what your textbook has for the premiums and rebates. Your textbook, keep in mind, was written originally for the US market. So some of their examples are still like US oriented. And if you folks, I don't know if that show still is there. There was a show called Extreme Couponing. It was quite the rage in the US. I don't think we have something similar in Canada, but there you still have companies that have make use of coupons and stuff to entice customers and shop. So the examples that you'll find for coupons and premiums in your textbook, they may not be as applicable to us in Canada. Okay. And then finally, we've got contingencies that we're going to look at. So contingencies depend on some future event, right? If something happens in the future, then if we need to act, if we will become liable as a result, then we will be looking at a contingent liability, and that's going to result in a possible loss for us. So depending on whether the amount, whether there's a what the likelihood of the future event is, and whether the amount expected to be paid out can be determined, we will need to set up a liability, otherwise simply disclose. And the most common example for that you're going to find is, oh, there's a lawsuit, right? Somebody sued us. So somebody's suing us for X amount of dollars. Half the time, those lawsuits are just nuisance lawsuits, and they're really not going to go anywhere. But sometimes, there might be a little more context, and we may end up being found liable in the court of law, or there is a likelihood that the case can just drag on forever, and we don't want to, take the risk. Um, so we might have to settle out of court. So if something like that, is the possibility, then we may have to set up a contingent liability. Any kind of contingent gain is typically not recorded. There's a very rare occurrence in which it can be, but mostly keep in mind contingent gains we don't record. But if there's a contingent liability, right, if we may have suffer a loss due to some future event occurring, then we may have to record a liability for it. And one other instance for contingencies might be if a company provides a financial guarantee. In personal life, some of you may know, either you have a family member or you know of someone, let's say, that maybe didn't have a very good credit rating, and they wanted to buy a house, or maybe they were new to Canada. I know my friend, his sister moved to Canada from India. So her family didn't have a good credit background because they hadn't been in Canada for long, and they wanted to buy a house. So they had the money to, for the down payment, but the bank, and they didn't have enough income, right? They didn't have enough income to show. So the bank asked if they could get someone to co-sign the loan. So my friend basically co-signed. So the result of that is my friend basically has provided a financial guarantee. Now he doesn't expect that his sister's family will not be able to fulfill the loan, pay off the mortgage. But if something were to happen, the bank can possibly ask my friend to step up and make payment. So that can also happen for companies. Right? If a company provides a financial guarantee, then if it is expected that it'll have to pay as a result of the financial guarantee, a liability needs to. Again, it's not something that happens on a day-to-day basis. But if you come across it, know that it's a liability, it's an obligation that the business has to do something about, right? And purchase commitments, it's where you've signed a long-term contract to buy something. Um, if it's a non-cancelable contract, right? So to give you an example, let's say um, right now with the crude oil prices being high, um, WestJet decides that it wants to make sure that it has supply of jet fuel for its planes. So it wants to get, I don't know, 20 million liters of jet fuel, and it signs a contract with the company to provide it at a rate of, I don't know, $1.50 per liter, or something like that. Now, right now, $1.50 per liter might sound like a pretty good price. However, we don't know what's going to happen in the future. Say 6 months from now, suddenly crude oil prices have dropped precipitously, and jet fuel might be selling for $1. But WestJet has signed the contract to buy that quantity for $1.50. So at that point, if WestJet still has not completed its order of purchasing the 20 million liters, say it's only bought 10 million, it's got still another 10 million due. Well, what WestJet needs to do is ask itself, can it cancel the order? Sometimes the order can be canceled without any penalty. Well, then it's not an onerous contract. WestJet will simply cancel and walk away. Usually there are some penalties. So WestJet will ask itself, okay, what's the penalty that I have to pay? I've got 10 million liters to buy more. The current price is $1. I've signed to buy jet fuel at $1.50. So I'll be overpaying by 50 cents for 10 million liters. That's $5 million. But maybe I can pay a breakage fee of $1 million and walk away. WestJet will say, you know what? I can pay the $1 million to cancel, right? The penalty to cancel and walk away. That is the onerous contract. And WestJet will have to set up a liability for the $1 million. if it chooses not to cancel, right? WestJet says, okay, we're going to wait and watch, but at this point in time, we will set up a liability for $1 million because it represents an onerous contract. So again, depending on circumstances, you may have an onerous contract, you might not. So the key here is not to get lost in the details. There are many different examples, many different circumstances. What can happen is sometimes it just overwhelms us and we get a bit flustered about, well, how am I going to do the math? How am I going to do this? First of all, decide, is there a liability? Do we have a present obligation? Right? Is it because of past events, etc.? Does it meet the criteria? And then look at the circumstances to determine how much, right? How much do you reasonably owe at this point in time? If the payment will happen at a much later date, you have to consider time value of money, otherwise, no, right? So that's kind of the general framework with which we would need to work. I'm going to try to get through as many of these examples. I might have to prioritize. It's 7:21, and what I would propose is maybe it wouldn't be a bad idea to take a short break at this point, maybe 10 minutes or so that you can kind of just get a bit of a stretch break and come back. And what I'm going to do is I have this file, and let me just paste the link here. It's there on D2L as well. If you click on that link, you'll be able to open this in Google Sheets. So Google Sheets is kind of like Excel. And I've not given you privileges to type anything in this file because this is a master file. But what you can do is you can click on File at the right left corner, at the top left corner. So if you click on File, you can actually download this as a Microsoft Excel file. And I'm sorry, I don't know everybody's life circumstances here, but if at all it is possible for you to have two screens, like one screen that you can view what I'm doing, and on another screen, if you kind of have a copy of this file open, you can actually try to do what I'm doing together. If not, that's okay. You can always download the updated. So as whatever I'm doing, it will get updated on this particular file link. You can download it later for your notes, no problem. You can delete, right? If you make a copy of this, you can delete what I've done and redo the question, right? So again, if you don't have a textbook and you still need to do some practice, do the questions we are doing in class again. So that's what we are going to do. And I've kept talking and we're at 7:23. So will it be okay if we came back in about 10 minutes? So around 7:33, 7:34-ish? Yeah. Okay, I will just pause the recording for now. Are we good to resume? All right. So I want to get us started with a look at problem 13.1. Now, the reason why I picked this one up is it's just got a nice little 11 different transactions types that it exposes us to. So hopefully it'll give us a nice look at a whole bunch of different current liability scenarios. And we don't necessarily have to, memorize our way through. Keep in mind, a liability is present obligation, right? You have an obligation now. You will need to pay cash or transfer some other asset in the future at potentially unfavorable terms, and you really can't get out of that situation. So we're gonna be looking at the situation of this company called Pendlebury Department Stores. It's got a December 31st year end. It operates in the province of Manitoba. They picked up Manitoba because Manitoba has a provincial sales tax. The rate is 8%, and GST is 5%. You don't necessarily have to memorize the rates. If at all it shows up on an exam question, the rates will be given to you. And we're told that PDSL follows ASPE, so it's a private company, and it has a periodic inventory system. The requirement is to prepare journal entries to record the transactions on the date that they occurred, and any adjusting entries that be needed uh, to bring the December 31st financial statements up to date. And then figure out what the amount would be to report for current liabilities on the balance sheet. Okay, so starting with the first one on February 2nd, and I'm just gonna do the journal entries, just do the journal entries out here so that we can compare. So for number one, we have February 2nd, um, PDSL placed an order to buy goods for resale from Hashmani Limited for $46,000 plus GST. Terms of purchase are FOB destination, net 15. So FOB destination, you might remember from your first intermediate course, is freight on board or free on board. Destination implies that the title to the goods passes to PDSL from the seller hash money when the goods are delivered. So on February 2nd, PDSL has only placed an order. They haven't yet received the goods. And since they haven't received the goods, they they basically can't record the purchase yet. They need to wait until the goods are delivered. That happens on February, the goods arrived on February 6th. So February 6th is the date that we're going to record the transaction, right? So Feb 6th. And for PDSL, from PDSL's point of view, they've bought inventory. Now, if this company was using the perpetual inventory system, you would debit inventory. But we're told that they use the periodic inventory system. And again, they're just trying to make this more complex than it needs to be. So, but under the periodic inventory system, you'll recall that we don't use the inventory account. Instead, we use other account names. So here, when you're buying the goods, you're going to debit purchases, and the amount of the purchases is $46,000. So debit purchases for $46,000. Now, we have GST on top. So we bought the goods for 46,000 plus GST. The rate for GST is 5%. And the hint we've been given is inventory for resale is bought PST exempt. So these are basically not, they've got nothing to do with accounting, folks. The fact that goods that are bought for resale are PST exempt, it's a legal thingy, right? So don't get too flustered here. The question tells us that there's no PST in this case. There's only GST. Now, the way GST works for a business is that when a business pays GST, they are able to recover the GST from any GST they charge from their customers. So some businesses will use a GST recoverable amount. Some others will use a GST receivable amount account. It totally depends on you. So here, if we went with GST receivable, the amount of goods and services tax on $46,000 at 5%. If I calculate 5% of 46,000, you see that's $2,300. That's the GST. And we have to make payment of 46,000 and $22,300. Total of 48,300 needs to be paid to the supplier, hush money. So that represents for us accounts payable. Debit purchases for 46,000, debit GST receivable, $2,300, and credit the accounts payable, $48,300. Our terms are net 15, there's no discount available. So 15 days from February 6th is February 21st. We paid the invoice on February 20th. So Feb 20th, debit the accounts payable because we are paying off the liability, and credit cash. There's no discount and all, so 48,300. All right, so that's the journal entry for transaction number 1. For transaction number 2, April 1st, the company bought a truck for $50,000 from Schuler Motors, paying $11,500 in cash and signing a 1-year 8% note for the balance of the purchase price. The provincial sales tax is 8%, GST of 5% were charged by the supplier on the purchase price. So what do we have? We have cost of the truck, is 50,000. The GST will be 5%. So 5% of 50,000 is 2,500. And the provincial sales tax is 8% of 50,000. That's $4,000. Now, for the GST, we get to recover it, right? So GST is an input tax credit. PST is not. Any provincial sales tax that you paid, you're just going to have to add it to the cost of the asset that you bought. So the truck that we bought, its original base cost was $50,000. The 8% provincial sales tax simply gets added. Now we're in Alberta. We don't have a PST. So you might kind of say, why should I bother? So just think of it as, okay, if you're committed to living in Alberta for the rest of your lives, grand. But if there's even a small chance that you might move to Saskatchewan or Manitoba, well, then it won't hurt to know how PST operates. All right. So what we are going to do is on the date that we bought the truck, which is on April 1st, we're going to debit truck or vehicles for $50,000 and $4,000. $50,000 was the original cost. Add 8% PST on top, that's $54,000. The GST, we get to offset against GST that we charge our customers. So GST is 2,500. Now, the total price, therefore, is, well, including GST, PST, and everything, is 56,500. We paid cash of $11,500. Credit cash, 11,500. And for the rest, $45,000, we have signed a note payable. Credit note payable for the rest, $45,000. All right. Now, I like to show the adjusting entry as well. So for this note, it's an 8% note, the 1-year note. So if we signed the note on the 1st of April this year, the note will actually be repaid on the 1st of April next year. But we have a year end of December 31st. So you know that we need to accrue interest on the note. We will have to accrue interest on the note at year end, which is December 31st. So on December 31st, we will have to record interest expense on the note. And since we are not paying the interest just yet, credit interest payable. And I'm sure this is something that you would have picked up in accounting 215 or 255. So it's basically 8% of $45,000. That'll give you a full year's interest, but we will only be accruing from the 1st of April to December 31st. How many months is that?
9.
9 months. So years got 12 months. So 9 months is a fraction of a year. So let's take it 45,000 times 8% times 9/12. That gives me $2,700. And that's what we accrue on the note. All right. Number 3, on May 1st, PDSL borrowed $83,000 from First Provincial Bank by signing a $92,000 non-interest bearing note due 1 year from May 1st. Now you can clearly see we borrowed $83,000, but the note amount that we've signed is $92,000. We can't say there is no interest, right? I mean, we only got $83,000 in hand. But when we pay back this note, we're going to have to pay back $92,000. The difference between the face value of the note, 92,000, and the amount that we actually got from the bank, 83,000, the difference of $9,000 is basically the interest. So when they say it's a non-interest bearing note, keep in mind there's no such thing as a free lunch. There's no such thing as a zero interest note. You might not have to make interest payments on the note, but that doesn't mean there is no interest, right? So that's one of the first things you got to keep in mind. The face value of the note is 92,000. That's what we'll have to pay back. The amount borrowed, well, that's only 83,000. So there is interest, right? The difference of $9,000, that's interest for 1 year. Now, on the 1st of May, the company only got $83,000 of cash, debit $83,000 cash, and credit note payable for the $83,000. So keep in mind, we are going to have to record a total of $9,000 for interest. So come December 31st, we're going to have to accrue interest on this note as well. And so that's done by debiting interest expense. And since we're not going to be paying interest separately, you can credit the note payable. Now, from the 1st of May to December 31st is 8 months. For a full year, the interest is 9,000. Can you figure out how much it should be for 8 months? If 9,000 is for a full year, for the 8-month period, it should be 8/12 of 9,000. So 8/12 of 9,000 works out to $6,000. Get the same number?
Yes.
Yeah. Okay. No rocket science so far, I'm hoping, right? It's not too scary. It's stuff that we've seen before. So just kind of a repeat of what we already know. So number 3 is done. Number 4, on June 30th and December 31st, PDSL remitted checks for $19,000 each as installments on its current tax liability. So that's basically debit income tax expense. Oh, sorry, I should put the date. So we sent the first check on, was that June 30th? Yeah. So June 30th, debit income tax expense and credit cash, $19,000. And then do the same for December 31st. They basically sent their income tax installments. Big deal. Number 5, there's no liability as such, right? So you're just kind of sending in installments. So the liability is determined at the end of the year. not during the year. That's why we are using expense rather than debit income tax payable. Okay? Because the payable, like we don't know what our actual net income is going to be for the year. Like that's only something that we determine at the end of the year, right? So we don't know what our income tax expense is going to be as such. So when we pay our income tax installments, just debit the income tax expense for the time being. Now, something that you are able to do if you're following along here, no, apparently I've not even given you the commenting privileges. Let me just update that to commenting. So change this to comment. So what you can do if there's something that strikes your mind is at your end, uh, if you have clicked on the share link, and if you didn't, here's the link again. If you want to just keep a note for yourself, what all you need to do is just right click and you can put in a comment, right? You can click comment and here you can sort of make a note for yourself, right? So um, income tax liability not yet determined, so debit expense, like something that you want to be able to remember in the future. You're able to do that and it'll just save as a comment. All right, that is something that you'll be able to do here. Number 6, on number 5, on August 14th, PDSL's board of directors declared a $13,000 cash dividend that was payable on September 10th to shareholders of record on August 31st. So this one, of course, I would imagine you've learned how to record dividend entries. So August 14th is when the dividend got declared. That's the date that we go ahead and debit dividends. You could also debit retained earnings if you like for the $13,000, but we're not paying the dividend yet. So credit dividends payable. That's the date the dividends got declared. Then there's going to be a date of record. The date of record is for this company, September 10th. On September 10th, there's really no journal entry that's recorded. Only shareholders list is finalized. So the shareholders that are going to get the dividend, we prepare a list of who they are. No journal entry as such. And then when the dividend is actually paid, the date of payment, oh geez, sorry, that's August 31st. September 10th is the date that they actually pay the dividend. So on September 10th, they're gonna debit dividends payable and credit cash for the $13,000. That okay? And just in terms of pacing, is this okay? Do I need to slow down a bit? Can I speed up a little bit maybe? Just to get a sense, right? I don't want to be too slow nor too fast.
I feel like the pace is okay.
All right. Okay. Thank you. I will stick with it. Number 6. On December 5th, PDSL received $750 from Jefferson Limited as a deposit on a trailer that Jefferson is using for an office move. The deposit is to be returned to Jefferson after it returns the trailer in good condition. That's going to happen in January. So this is basically an amount, it's a deposit that we'll actually have to refund as long as the customer brings back. So we're in the business of, gosh, what are we in the business of? We're in the business of, we're a department store. I don't know where the trailer came up. So maybe this company, it's like Home Depot will rent out equipment, right? So maybe they're also kind of doing a U-Haul type service as well. So somebody is, renting out a trailer and we've taken a damage deposit from them. That's all. So, but this is a refundable amount. So we're getting cash, but this is cash not for us to keep. This is cash that we are holding just as a safeguard against any possible damage that happens to our property. Okay, so that's a refund liability. So on December 5th, we're getting cash $750. But you don't want to credit unearned revenue because there's no revenue to be earned. Okay, so this is an amount that we potentially have to pay back. Now, if Jefferson brings back the trailer in a trashy state, then yeah, we'll keep the $750 and maybe sue them for more money. But as of this point, December 5th, it's a refund liability. And they kind of told us in the question, use the account refund liability. All right, number 7. On December 10th, the company purchased new furniture and fixtures for $8,000 on account. Provincial sales taxes of 8%, GST of 5% were charged by the supplier on the purchase price. So, it's kind of like this truck purchase. So the cost of the furniture we bought the furniture for 8,000, was it? Yeah. So yeah, the cost of the furniture is 8,000. The GST works out to 5% of 8,000, so that's $400. And the provincial sales tax is 8%, so that's $640. Now, this is a purchase that takes place on December 10th, and we bought it on account. We didn't pay any cash. December 10th, debit furniture and fixtures. Now that'll be the cost plus the PST, okay? The provincial sales tax you're gonna add. For the GST is something that you're able to recover. So debit GST receivable. That's gonna be $400. And since we bought it on account, the entire amount, $9,040, we're gonna credit accounts. Okay, number 8. During December, cash sales of 79,000 were recorded, plus 8% provincial sales tax and 5% GST that must be remitted by the 15th day of the following month. Both taxes are levied on the sale amount to the customer. Ignore any cost of goods sold. So the sale price, base sale price is 79,000. So GST at 5% works out to 3,950, and the provincial sales tax at 8% works out to 6,320. Now, how do we record it? So for the month of December, these are numbers for the month of December. So I say December 31st is when we're going to record this sale. This was all done on cash, I think. Like there's no indication about how else this was cash, clearly cash sales. So debit cash. And we collected 79,000 plus the GST plus the PST. Okay, so we collected a total of 89,270 from our customers. Now, out of that amount, we have to send $3,950 as GST. GST payable. We have to send that to CRA, okay, 3950. The provincial sales tax is also not something that we get to keep, unfortunately. approximately. That has to be sent to the province's coffers. So it's sales tax payable or PST payable if you want. 6,320. So really, as far as our sales revenue is concerned, it's basically the sales price, 79,000, right? So that's our sales revenue. The rest of the money we collected, we have to just pay it forward. We don't get to keep it. Other than the GST, right? So the GST we do get to offset. Number 9, PDSL's lease for its store calls for $2,500 monthly rental payments plus 3% of net sales. The payments due 1 week after month end. Now, this one's interesting because we have to figure out what the percentage of net sales is going to be for the month of December, right? So for December 31st, number 9, right? It's December 31st that we have to make the payment. Now, our sales, right? Our cash sales, there's no information about any credit sales. So cash sales is 79,000. So the variable portion of the rent, right? Variable portion of rent, 3% of sales. You calculate 3% of 79,000, right? So we have to, it's kind of like, you know, there are certain businesses that, you know, they are charged a flat fee, but also, you know, they have to pay a portion of their sales, like concession stands. Like if you think about the Saddle Dome, right? So when you have games, you know, where the Calgary Flames are playing, you know, you usually have a typically high turnout of the crowds, and that day probably, you know, the sales levels are higher. So the Calgary Flames management might have a rental agreement where there's a certain base rent, and then depending on what the turnover is, they also, you know, get a little bit of the action there. So this is kind of what's happening. There's a variable portion, and then there's a fixed portion of the rent. Total rent that we have to record, and it's not something that we are paying right away. It's payable because we'll have to pay the rent 1 week after the month's end. So after the month of December is ended, 1 week after that is January 7th. That's when the actual payment's going to happen. So as of December 31st, you're going to debit rent expense. Now, $2,500 is fixed. Add to that $2,370, the variable portion, and our total rent for the month of December is $4,870. And since we're going to pay it in January, this is a liability for now, rent payable. And for rent, there's typically no GST, right? If you happen to rent an apartment or something, you know that there is no. If you happen to be a landlord, also, real estate is GST exempt when it comes to renting. Okay, there's no the GST that you pay. It only is when you initially buy a new house, right? If you happen to buy a new house from a developer, that's when they add the GST. After that, any kind of later on, if you were to buy a house, like a secondary purchase, there is no GST. And if you are a landlord and you're renting your space, there's no GST, right? So skip the GST part. There's no PST as well on rent. Okay, number 10, PDSL was advised that during the month of December that it's legally required to restore the area surrounding one of its new store parking lots when the store is closed in 12 years. So that's a decommissioning obligation, like a decommissioning obligation. Um, in ASPE, it's called an asset retirement obligation, ARO. Now we're told that the account to use is land improvement because land is something that's got an indefinite life. But if you have to restore the area, now I don't know what they mean. Maybe they have to dig up the parking lot, right? So get rid of the paved area and then just maybe plant new trees and so on. Maybe that's what they need to do. Anyways, it's going to be recorded as a land improvement, and it's got to be recorded at the present value of whatever the amount in future is going to be. So they, in the question, give us that the fair value of this obligation at December 31st is $46,000. That's what we're going to do for number N. Debit land improvements for the $46,000. And we're going to credit an asset retirement obligation. If this was IFRS, we would have used decommissioning obligation. All right, number 11, and I guess that's the last of it. So number 11, the corporate tax return indicates taxable income of $205,000. The company's income tax rate is 20%. So my taxable income is $205,000. Then my income tax at 20% is 20% of 205,000, which is 41,000. Now keep in mind, I've already paid income tax installments. 19,000 on June 30th, and then 19,000 again on December 31st. So I've already paid $38,000 in installments, right? So income tax payable is just the difference, 3,000. As of December 31st, I'm going to debit income tax expense and credit income tax payable for $3,000. And that, my hearties, is part A of this question. We've gone through the journal entries. Do you have any question on what we just did?
Can you just scroll down to the last question again?
Sure. And just so you know, if you click on the, like if you do click on it, the file will show up at your end, and you are actually able to scroll up and down on your own as well. And Sue's asking in the chat box, for income tax, can we also use prepaid income tax? So since you're paying tax installments, Sue, it's best to just debit the expense. You can, like, I don't think there's any law against it. You can very well use prepaid income tax, and then at the end of the year, you calculate what your total income tax expense is. So yes, you could have theoretically debited a prepaid income tax account, and then at the end of the year, you would then do debit income tax expense for the entire 41,000, credit prepaid income tax 38,000, and then credit income tax payable. Like, since it's for the current year, it's kind of like since it's for the current year, it's best to just expense it as you go. But yeah, I don't see any accounting reason for why you can't. So something that you have to keep in mind, folks, is that accounting standards tell you how you need to report something, right? So ASPE, IFRS, These are standards that tell you how, when you're preparing the income statement, balance sheet, how you should present the item. How you actually record the debits and credits is actually not something that the accounting standards tell you. So in real life, you'll find a lot of variation as how the what the specific account names are that the companies use. When it's time to present, do I present the amount as a current liability? Do I present it as a long-term liability? Do I present something as a, like those are the things that the accounting standard. Lisa has a question. For the first transaction, do we need to adjust the purchases and put it into the inventory account at the end of the year? Debit inventory, credit purchases. Yes, Lisa. So we don't have enough information to do the adjustment to the, so there needs to be more information given to us, including the beginning inventory, what the ending inventory is, and so on. So I'm kind of leaving it. We just don't have enough information. But if you want, you can close it out against inventory. But I just think that we don't have enough information to actually do a cost of goods sold adjustment here. Where can we find this recording? So this recording is being prepared right now, Tony. Once the recording is done, and I usually am a little tardy, so I'm going to be posting it tomorrow because Zoom takes a while for the recording to be finalized. You will find the recording on D2L. So for us here, so my page, chapter 13, you'll find the link to the recording on D2L here. So there would be a link for class recording. And Maria, yes.
Yeah, I have a question about the first question, the problem. We not
Yeah.
have we not get a discount of 50%. Well, no, it's not say any percent, right? If we paid
Yeah.
in 15 days.
Yeah. So if there was, let's say, a 1% discount or 2% discount, because we made the payment within the 15-day period, you will just record that. So you'll go debit accounts payable 48,300, and say there was a 2% discount, for example. Then um, you would need to calculate the 2%, and then you will reduce cash paid for, like, you'll basically record the cash that you actually paid. But what will mess things up there is you will have to do the allocation. You'll have to figure out, so the discount itself will need to be calculated based on 46,000. And any portion that relates to the GST will have to be adjusted against the GST. So that is why these, the person that wrote this question tried to ignore the discount. It just makes it a little more complicated. Like you'll have to allocate the discount to the GST and so on as well.
Yeah, yeah. Oh, so it's just the net 15 means that only we need to pay
Yeah, it
the
just
max.
means that we have
Oh,
to
okay.
make the payment in 15 days. There's no discount here.
No, no discount. Okay.
If there was
It's the
discount,
due
it'll be
date.
harder. It'll be harder.
We
Yes.
got it. Okay, okay. Perfect. I got it. Thank you.
Mhm. All right. Now, part B of the question said identify the current liabilities that'll be reported on the balance sheet. So for this one, really what you have to do is, like, I mean, the best way to do it would be go through each of the journal entries. So over here, the accounts payable are paid off for number one. We don't have anything remaining. For number two, we have the note payable of 45,000. And then we have an interest payable of 2,700 that'll show up. Right? So this will show up and this guy will show up. So let me just splash some color. That will show up. The note payable of 83,000 plus the $6,000 that we accrued for interest, that will be reported as a current liability. Dividend has been paid out, so there's nothing remaining. The refund liability will be reported as a current liability, because that'll be taken care of next year. Now, for the GST, you have to look at, okay, so I've got $2,300 for GST receivable, $2,500 for GST receivable. So 2,300 plus 2,500 is $4,800. And then when I look at the GST, okay, another $400 of GST receivable. So total $5,200 of GST receivable. My GST payable was $3,950. All right, so the difference between the two, well, that's how much I will need to, so I will offset. My GST payable is smaller, $3,950. My GST receivable is $2,300, $2,500, and $400. So that's $5,200. So what I'll do is I'll offset my GST receivable payable, right? And what that's going to mean is I'm going to have a net GST receivable. So I wouldn't have any liability for the goods and services. All right. But I'm going to have a PST payable. So for the PST that I had, provincial sales tax that I recorded, and where was the PST? I had a PST of on the sale, yeah, the 6,320. That I'm going to have to report as a liability, 1,003. The rent payable will show up as a current liability. The asset retirement obligation is a long-term liability, so that doesn't get included in my current liability calculation. The income tax payable is. So if I was to prepare a listing of my current liabilities, the listing is going to include so I'm going to have the accounts payable is gone, isn't it? Do I have an accounts? Oh yeah, I've got an accounts payable here, 9,040. So I've got to have accounts payable for $9,040. Yeah, I'm just linking, so you can, like, if you press the F2 button, you'll be able to see where that came from. Then we're gonna have notes payable. So notes payable, we will have two notes. We're gonna have 45,000, and then we're gonna have 83,000, and then the interest that we recorded 6. The notes payable is gonna be $134,000. Interest payable, well, that's the 2,700. Then I've got a refund liability. And refund liability is $750. And then what else do I have? That's gone. PST payable. That's 6,320. Got a rent payable, 4,870. And I've got an income tax payable. And that is $3,000. So my total current liabilities is $160,680. right? So you notice what I did is I just linked it to the journal entries. So that way, you know, if somebody wants to see where the number came from, you can identify it. Is that okay? Awesome. All right. What is 1311 and 1312 about? Sick days. Okay, I'm going to skip this because this is a little less important than, say, an asset retirement obligation. So over here, exercise 1315. On Jan 1st, 2020, Offshore Corporation erected a drilling platform at a cost of $5,460,000. Offshore is legally required to dismantle and remove the platform at the end of its 6-year useful life at an estimated cost of $950,000. Offshore estimates that 70% of the cost of dismantling and removing the platform is caused by acquiring the asset itself, and the remaining 30% of the cost is caused by the using the platform production. So this company, you know, like, so IFRS says certain amount that is attributable to the asset itself. Any changes in it is, you know, are recorded in what you call it, are added to the asset, whereas any changes in the obligation that result from the operation, right? You know, maybe you're taking out more crude oil than normal and so on. Well, then that should be added to the inventory, right? So the crude oil for this company will be inventory, so that gets added to the inventory. Okay, so present value of the increase in asset retirement obligation related to the production of oil in 2020 and in 2021 was so much and so much respectively. And the estimated residual value of the drilling platform is 0. Offshore uses straight line depreciation, and it prepares financial statements in accordance with it. All right, okay. Right, so first, as per IFRS, we have to calculate the present value of the asset retirement obligation. The 950,000 is the cost in 6 years' time. That basically represents the future value. 950,000 is the future value. There's going to be no payment made in the interim. And we need a discount rate here, right? So the discount rate, what is my discount? Am I missing something? That is weird. There's no discount rate given?
Would it be the total amounts per year that's given you? Like the asset retirement obligation related to
No, but
production?
you know what, this 950, right? So the 950, we have to calculate a present value for it,
Mm,
right? So when we're calculating present value, we need an I by Y. That
Yeah.
is really weird. They have not given us an I by Y. Okay, I'm just going to log into Wiley Plus, okay? Maybe I missed something when I copied the question. Volume 1, don't need volume 1. Assignment material exercises. And this is exercise 13, 15. Oh, Jews, an appropriate interest or discount rate is 8%. When I copied the question, I did not include that. So discount rate is 8% given. Without the discount rate, we can't really move forward. I by Y is 8%. Now, if you folks use your BA2 plus calculator, your calculators are set up to recognize that the I by Y is a percentage. In Excel, you have to specify that it's a percent. Otherwise, it doesn't know. Google Sheets is kind of like Excel. So the formula that you want to use to calculate the PV, present value, is PV. You're using Excel. Excel is nicely set up. You can just go in and input what it wants, and then it spits out the answer. So for us here, if you think about it, 950,000 is what this company will have to pay in 6 years' time. So put that in as a negative, because that's money that's going to be going out in 6 years' time. There's no other cash to be paid for the 6 years. If you calculate present value, the formula is PV. And if you open, then Excel will also give you the prompts, and so also will Google Sheets. So Google Sheets says, tell me first, what's the rate? So my rate is 8%. So I click there, comma. What's your number of periods? Well, that's 6. So I 6, comma. What's your payment amount? Well, it's 0. Okay. What's your future value? Negative 950, because I expect to pay. And then the last little bit is the type. Well, the default is end of the period, so you don't have to put anything. Enter, you get present value is 598,661. So PV of the $950,000 is 598,661. I want everybody to make sure that they're able to calculate this, please. Get stuck, I can maybe help you out here. Okay, looks good. So then part A, prepare the journal entries to record the acquisition of the drilling platform and the asset retirement obligation for the platform on Jan 1st, 2020. So that's my part A. Jan 1st, 2020. We acquired the drilling platform for $5,460,000. You want to debit drilling platform. $5,460,000. And we're just assuming we paid cash, so credit cash. And on the same date, you're going to debit the drilling platform and credit a decommissioning obligation. So under IFRS, the terminology is decommissioning obligation. Asset retirement obligation is the term used in ASPE. Decommissioning obligation is what you want to use for IFRS. And they said 70% of the cost of dismantling is caused by acquiring the asset itself. So 70% of 598,661. So times 70%, 419,063 gets added to the cost of the drilling platform. You credit a decommissioning obligation for it. Now, what happens is over time, the decommissioning obligation is accreted to value. How does that happen? Since we set up a rate of 8%, right? So we start with Jan 1st, 2020. And we have a balance of 598,661. Every year, right? Every year. So December 31st, 2020, December 31st, 2021, and so on for 6 years, right? 6 years. We're not going to make any cash payment. Every year, we're going to charge interest at 8%. And what's that going to do is, since we're not going to be paying any cash, every year we're going to charge interest at 8%. So first year it'll be 47,893. Since there is no cash, the interest will be added to the balance. So amortization would reduce the balance of the liability. Since we're not paying any of the amount in cash, the negative amortization results in the liability going up. Next year, same thing, you calculate interest at 8% of 646. The amortization is going to be 51,724 negative, and a negative amortization will cause the liability, the decommissioning provision, to go up. Now, if you repeat this for 6 years in total, you'll find that the decommissioning provision goes up to 950,000. Now, because this company said 70% of the decommissioning cost belongs to the asset and the rest is due to the use, if I calculate 70%, right? If you calculate 70% at the beginning, you got the liability of 419,063. You calculate 70% through and through, you get those numbers. And if you look at the change that happened in the first year, the first year's change was 33,525. That's the number they gave us here. Nope, that's 3328. Oh, so this is the increase in asset retirement obligation related to production was those numbers. This is how much is related to the asset itself. So 33,525 will be because of the asset, and then 36,207, 70% of the change in the liability. Well, that's going to be for the next year. Anyhow, this one I'm just gonna put this in red for now, because for us part A was just this journal entry. For part B, they're saying prepare any journal entries needed for the platform and the asset retirement obligation at the end of the first year. So part B, December 31st, 2020. Now, for the asset, we had originally recorded the asset for a total cost of 5,460,000, and then we had added 419,000 and change to the cost of the drilling platform. Right? So the total cost of the drilling platform that we recorded is 5,460,000 plus the 419,063. So annual depreciation, because the useful life is 6 years, the annual depreciation works out to 979,844. So that is what you're going to record here. Debit depreciation expense, credit accumulated depreciation, for the drilling platform, depreciation is 979,844. Now, secondly, what you have to do is the decommissioning obligation needs to go up. Right? If I had, instead of starting with 598,661, if I had looked at only the decommissioning obligation, so if I had instead started with 419,063, notice that that 419,063 will grow over time, and the amortization numbers that you're seeing here were what I had calculated earlier, right? The 33,525, 36,207, et cetera, and over time it takes you to 70% of 950,000. If you calculate 70% of 950,000, the liability should be 665,000, and that's where it will take us. So December 31st, you want to increase your decommissioning provision. I want you to pay attention on like the debits and credits we'll figure out, but just look at what should happen to your decommissioning obligation. You started with 419,063. At the end of the first year, you need it to be 452,588. So you need this obligation, right? This liability to go up. When you want the liability to go up, liabilities are credits. So what you want to do is credit the decommissioning obligation as part of your adjusting entry. All right, so credit decommissioning obligation. The amount you want to credit it by is 33,525. And what is that 33,525? It's interest expense. Or you could have used finance cost. That is also allowed. All right. Now, the other number that they gave us in the question, 32,328, that, mind you, was a result in the decommissioning provision, the decommissioning obligation related to the production of oil. So for that, what you want to do is it cannot be recorded as interest. You have to instead inventory it. So debit inventory and credit decommissioning obligation for the number that they gave us, which is 32,328. Any amount of increase in the decommissioning obligation, I'm gonna make a note here, any increase in the decommissioning obligation due to production is recorded inventory. Okay, so this is kind of one of those requirements of the accounting standards So if there was an increase in the obligation just due to passage of time, that'll be recorded as interest expense. If there's an increase due to production, then you have to record it as inventory. Right, so those would be your journal entries for December 31st, 2020. Part C asks for the journal entries for December 31st, 2021. So it's going to be similar. It's going to be pretty similar to what we just recorded. You're going to record depreciation expense. So every year, my depreciation expense is $979,844. My interest expense for December 31st, 2021 is going to be different. So my interest expense is going to be $36,207. My decommissioning obligation will go up for that. And the increase due to production, the question told us is 34,914. So 34,914 is what I'm going to record as an increase due to production. Okay, and then part D, assume that on December 31st, 2025, the company dismantles and removes the platform at a cost of $922,000. Assume that at that time, the carrying amount of the asset retirement obligation is $950,000. So basically, you have a liability, right? On December 31st, 2025, we have a liability on our books at $950,000. And the actual payment that we had to make to settle the liability was $922,000. So if you set that up as a journal entry, December 31st, 2025, you want to debit your decommissioning obligation, $950,000. We got to settle it by paying cash of $922,000. Now, obviously, there's a difference. That difference of $28,000, it's basically we were able to settle our liability at less than what the carrying amount was. So that represents a gain on settlement of decommissioning obligation. I'm just abbreviating here. Now, to answer Lisa's question about if we are not given numbers for the increase due to production, then there's really no way for it to be calculated, Lisa. So this is something that companies calculate on an ongoing basis, right? So let's say, and the way they do it is they would, when they bought the drilling platform, right, they would have done some geological survey and estimates of how much of oil that particular platform was going to find, right? So they would have estimated reserves of, let's say, 1 million barrels. Now, the cost that they have recorded, or even the asset retirement obligation, let's say, it's based off that $1 million barrels of oil. Now, 6 years, if they divide 1 million barrels by 6, you get a fixed amount of how much they should be producing. But in certain years, maybe they would take out more oil. In other years, they might take less oil out. Now, the impact on the asset retirement obligation in the year that they pumped out more crude oil, because the total amount of crude oil reserve is fixed. In the year that they're taking out more crude oil, the retirement of the decommissioning obligation will go up because of that, because we produced more. And in a year that we produce less, the increase would be a little lower. So the calculation is actually done in the real world based on how much or how little we've been producing, and it's kind of based on units of activity. So unless the question gives us the numbers, there's really no way for us to actually calculate it. Okay, so that was a look at IFRS.
And why I'm revisiting this question. And thank you to Lu Zhao for sending an email about it. And so I wanted to just go over the ASPE part. Hopefully this will be good revision. So we were asked in part E to repeat parts A through D, assuming that the company prepares financial statements in accordance with ASPE. So under ASPE, we would still calculate the present value of the expected cost to dismantle the platform. So we're looking at a future value of $950,000. And because it's cash going out, I'll put that in as a negative. There is no annual payment. So the PMT amount is 0. The number of periods is 6 because there's 6 years before to go before the drilling platform will be dismantled. And the discount rate we were told to use is 8%. Using that, we get present value 598,661. So under ASPE, we will record the drilling platform for the cash paid, $5,460,000. And then 70% of 598,661, 70% of that number, because it's related to the cost of acquiring the drilling platform itself, we debit to the drilling platform and credit asset retirement obligation. So that's one tiny difference. Under ASPE, we use the term ARO. Over time, this decommissioning, the asset retirement obligation in this case, will be accreted to its future value. Now, we learned how to calculate, how to prepare an amortization schedule. So we started with the balance of 419,063. There's no cash paid in any of the years. So every year, the asset retirement obligation is accreted at 8%, right? So under IFRS, we use the term interest. Under ASPE, we do not want to use the term interest, so use the term accretion, okay? So first year, 8% of 419,063 works out to accretion of 33,525. Because there's no cash paid, this amount basically gets added to the asset retirement obligation. Negative amortization increases the liability for us. And over time, you'll find that it takes us to $665,000. Now, $665,000 is nothing but 70% of 950,000. We can confirm that. 70% of $950,000 gives us $665,000, and 70% of the total cost to decommission was attributable to the acquisition of the drilling platform itself. So everything looks good. Now, for the first year, then the journal entries at the end of the first year, December 31st, 2020, we are going to record accretion expense for 33,525, and we are going to credit the asset retirement obligation along with recording depreciation. The total cost of the drilling platform we calculated to be equal to 5,460,000 plus the 70% of the present value of the asset retirement obligation that we calculated, 419,063. So total cost of the drilling platform works out to 5,879,063. And because there's 6 years remaining, that amount divided by 6 gives us annual depreciation of 979,844. Now, I also mentioned we record the accretion expense. So we go ahead and do that accretion expense, debit this accretion expense, and we credit the asset retirement obligation. Now, for the amount that we were given that's related to the production of oil, 32,328. This number, we had debited inventory under IFRS, but under ASPE, the amount actually gets capitalized to the cost of the asset. So the asset here is the drilling platform. So $32,328, we are going to capitalize to the drilling platform and then amortize it over time. So what that means is, and this is where I had not correctly shown you the solution during class, instead of, I had debited accretion expense, and that's not correct. We should debit the cost of the drilling platform itself, and the credit goes to the asset retirement obligation. Now, what that means is that we are adding $32,328 to the cost of the drilling platform. Now, we had begun with $5,879,063 as the cost of the drilling platform in 2019. We had recorded, or 2020 rather, and we had recorded depreciation for $979,844. So at the end of 2020, the remaining depreciable cost had gone down to the difference, $5,879,000 minus the $979,000. To this, you want to add the cost that we capitalize for the drilling platform. So add $32,328. Now, both these numbers added together give us $4,931,547. Now, for the the drilling platform, 1 year's useful life is over. So we're now down to 5 years remaining. Remember, the original life was 6 years. So now that you got 5 years remaining, if you divide 4,931,000 by the 5 years remaining, we get depreciation for 2021, 986,309. So come December 31st, 2021, we'll record depreciation on the drilling platform in the amount of 986,309. Okay. Now, secondly, we're going to record accretion expense on the asset retirement obligation, the original amount, 36,207. So that gets accreted. And thirdly, we're going to record the increase in the asset retirement obligation resulting from the production of oil, 34,914. Well, that we are going to debit the drilling platform cost and credit the asset retirement obligation. All right, and then the following year, the same process will continue. We'll have to recalculate the depreciation for 2022 and so on. Now, at the end of 2025, once the useful life of the drilling platform is over, that's when we will de-recognize it. And we're told that the company dismantles and removes the platform at a cost of $922,000. The carrying amount, we're told, is $950,000 for the asset retirement obligation. So this journal entry would be the same as for IFRS. We will debit the asset retirement obligation for the carrying amount of $950,000. And since we only had to pay $922,000 to settle it, we will get a gain on settlement of asset retirement obligation. Now that concludes exercise 1315. Just want to remind us of the ASPE IFRS differences. So number one, there is a difference in terminology. Number two, any changes in the asset retirement obligation due to passage of time are recorded as accretion expense, and any changes due to the usage itself, we capitalize to the asset and amortize. Now, there is a third difference that we should be aware of. Under ASPE, the discount rate used for calculating the present value of the ARO should be the risk-free rate. Okay, now this is kind of getting into very technical CPA territory. And under IFRS, we use a risk-adjusted rate. So in this problem, we used 8% for both IFRS and ASPE, and that is technically not correct, because if 8% was the rate under IFRS, and that was the rate that is adjusted to reflect the risk inherent in the company, the risk-free rate would typically be lower. And when you're using a lower discount rate to calculate the present value, you get a, and you can try it out, you use a lower rate, your PV will be a higher number. So just for example, if we can just play around here, if instead of 8%, if I had used if the risk-free rate was say 5%, you'll notice that the present value goes up, right? So the question in the textbook was not quite reflective of the accounting, the reporting standards. Under ASPE, we are supposed to use a risk-free rate when we calculate the asset retirement obligation. Otherwise, I guess we are on good footing here. So then moving on to take a look at exercise 13-21. And this is an example about warranties. So we're told that this company called Seltzer Equipment sold 500 items. They sell something called Rolomatics on account during 2020 for $6,000 each. In the year, the company spent $30,000 servicing 2-year warranties that are included in each sale of the Rolomatic. All servicing transactions were paid for in cash. So there's multiple parts to the question. The first part says, prepare the 2020 entries for Seltzer using the assurance type approach for warranties. Now, what's the assurance type approach? What you need to do is you need to estimate and accrue the warranty liability at the time of sale. And what most companies will do is they'll typically calculate the warranty expense either on a per unit basis or as a percentage of the sales amount, right? And then you record actual costs incurred later on by reducing the warranty liability. So in the case of Seltzer, we're told that the company estimates that the total cost of servicing warranties will be $120,000 for 2 years, and payments for completed warranty repairs are paid for in cash. So we're asked to prepare journal entries. So if we go with the assurance type warranty, then at the time of sale, because the sales occurred on account, you want to debit accounts receivable and credit sales revenue. And we sold 500 Rolomatics, $6,000 each. So that works out to a nice journal entry, debit the accounts receivable, credit sales revenue, $3 million. Now, they did tell us to ignore cost of goods sold, but you should keep in mind if we were given information about the cost of goods sold, we would have recorded that journal entry, debit cost of goods sold and credit inventory. And also at this time, the company, because the company's estimated the warranty liability to be $120,000, you're going to record a warranty expense and credit warranty liability for $120,000. Now this happens at the time of sale. Later on, when warranty repair costs are incurred, and in this company's case, they paid $30,000 to fix products that needed servicing under warranty. So when the actual warranty repair costs are incurred, at that time you debit the warranty liability and credit cash, because we're told that the warranty costs were incurred in cash. So that's an assurance type warranty. Now we could also have what's called a service type warranty. Now a service type warranty is typically related to extended warranty. right? Goes above and beyond the basic warranty. So the example we were using in class was if you go and buy an expensive appliance from Best Buy, they will try to convince you to get extended warranty just because you're buying a really expensive appliance. If something were to happen to it, then you'll have some peace of mind in the form of, okay, I bought a really expensive fridge. If something happens to it within 5 years, Best Buy will get it fixed, and I pay them a few $100s for the extended warranty. So that's called a service type warranty. Now, if you're dealing with a service type warranty, then the warranty is considered a separate performance obligation. So what you need to do is you need to allocate the transaction price to the service type warranty and record that as unearned revenue to start off. Later on, with passage of time, we recognize revenue. And as and when actual costs are incurred, we record them as expense. So coming back to the same facts here, in part B, we're told prepare the 2020 entries for seltzer, assuming that the warranties are not an integral part of the sale, but rather a separate service that is considered to be bundled with the selling price. Using the service type approach for warranties, assume that of the sales total, $160,000 is identified as relating specifically to the sales of warranty contracts. So out of $3 million, $160,000 is for the sale of warranty contracts. The rest is sales revenue. So at the time of sale, you're going to debit accounts receivable for the $3 million, credit unearned warranty revenue for $160,000, and then credit sales revenue for the difference. If you had any cost of goods sold information, you would record that as well. Subsequently, during the year, we incurred $30,000 of costs to service the items under warranty. You want to debit the expense and credit cash. Now, at the end of the year, the company is going to recognize warranty revenue. Now, how much revenue should it record? Now, there's a couple of ways that a company could do this. One would be just based on passage of time. So let's say if the sale had occurred, middle of 2020, July 1st, and it's a 2-year warranty, then you would have calculated 6 months out of 24 months and multiplied that by $160,000. Now, instead of that, we don't know exactly when the sales took place, so we can't really use a time-based calculation. So rather than that, we can calculate how much of warranty revenue is earned based on how much of costs relative to the total estimated costs have been incurred. So this company spent $30,000 servicing 2-year warranties, for which its estimate, and pretty accurate estimate at that, was that it'll cost $120,000 over 2 years. So you can do the math, 30,000 divided by 120,000, 25% of the cost has been incurred, and that means 25% of $160,000 of revenue is no longer unearned, but rather can be recorded as revenue. So that's what you do. You want to, at the end of the year, record warranty revenue for $40,000. Okay, and then part C, what amounts would be shown on the company's income statement under the 2 parts A and B? So if we take a look at what's shown on the income statement, for the assurance type warranty, we have sales revenue, $3 million. We compare that to the service type warranty, it's only $2,840,000. Under the service type warranty, there is no warranty revenue, right? We do record a warranty expense of $120,000 though. So overall, ignoring cost of goods sold, the effect on income before tax works out to $2,880,000. Now, in contrast, under the service type warranty, we actually recorded warranty revenue of $40,000 and our warranty expense is only $30,000, just the actual costs incurred. So if I put these together, 2,840,000, add 40,000 minus 30,000 for the expense, the total impact on income is $2,850,000. Now the two numbers are certainly not the same. So what's the explanation? Well, under the assurance type warranty, when we treat the warranty as part of the sale, we end up with a larger warranty expense, but the entire transaction price of $3 million got recorded as sales revenue. In contrast, when we treat the warranty as a separate performance obligation, we get a smaller amount being recorded for sales revenue. The recognition of the warranty revenue in turn gets done on some systematic basis. Could have been evenly over time, or in this case, we based it off expenses. So that was the reason why we had two different income amounts resulting from whether the warranty was considered an assurance type warranty or if it was considered a service type warranty. Now, the question didn't ask us for this, but I'm going to show you the comparison on the balance sheet as well. So as far as the assurance type warranty is concerned, remember, we had recorded a warranty liability in total of $120,000 at the time of sale. And then later, when the costs were incurred, we reduced the warranty liability by $30,000. So that nets out to a warranty liability of $90,000 being shown on the balance sheet. And we don't have any other unearned warranty revenue, etc., because under the assurance type warranty approach, we do not record any revenue for the warranty. The entire revenue was recorded for sales. Now, what about the service type warranty? We don't have a warranty liability as such, but we do have unearned warranty revenue. We got $160,000 recorded as unearned warranty revenue at the time of sale. End of the year, we recognize revenue totaling $40,000 on that. So 160 minus 40, we would have unearned warranty revenue, which is also a liability in the amount of $120,000. All right. So bottom line to remember is you got to look at the facts presented, whether the warranty that you're dealing with is an assurance type warranty. That means it's included in the overall price, or is it something that the customer is paying for separately, something that the customer can benefit from separately as well. So on that note, I am going to stop this video and I'll record a separate video showing the other remaining examples. Thank you. Hello, everyone. This is Harjinder, and in this video, I'm going to walk us through a few more examples from chapter 13. So starting with exercise 1323. This is an example on customer loyalty programs that we talked about when we discussed the chapter 13. When a company issues customer loyalty points, the points will be redeemed sometime in the future. So IFRS 15 takes the viewpoint that the customer loyalty points reflect a separate performance obligation, and the company must set up a liability, an unearned revenue liability, reflecting the fair value of the estimated redemption amount of those loyalty points. So taking a look at exercise 1323, to increase sales, Belanger Inc., a public company that follows IFRS, implemented a customer loyalty program that rewards a customer with 1 loyalty point for every $10 of purchases on a select group of products. Each point is redeemable for a $1 discount on the purchases of Belanger's merchandise in the next 2 years. Following the implementation of the program during 2020, customers purchased select group products for $100,000. Now keep in mind, every $10 spent gives 1 point. So $100,000 spent would mean 100,000 divided by 10, 10,000 points in total. And that's what was earned 10,000 points, redeemable for future purposes. Now, in parentheses, we're told all products are sold to provide a 45% gross profit. Now, that simply means that if for every $1 of sales value, the gross profit is 45 cents. And that would mean cost of goods sold is 55 cents. So if 45% is a gross profit margin, the cost of goods sold is equal to 55% of the sales value. The standalone selling price of the purchased goods is $100,000. Based on prior experience with incentive programs like this, Belanger expects that out of the 10,000 points that have been issued, only 9,500 points will be redeemed. So what we need to do is identify the separate performance obligations in the points program and briefly explain when the performance obligations will be satisfied. So to answer that part, keep in mind that you have two things happening. The company is selling the products which are delivered to the customer right away, immediately upon sale, but it's also giving the customers points that can be redeemed for product purchases in the future. So there are two performance obligations. The points, because they provide a material right to the customer, should be considered a separate performance obligation. So what needs to happen is that the total transaction price for the $100,000 must be allocated between sales revenue and an unearned points revenue account. And this allocation is done based on the standalone selling prices. So, and that is the subject matter of Part B, which asks us to prepare journal entries for the sales that took place in 2020. So keep in mind that under IFRS 15, the unearned revenue for the points will be based on expected redemption. The expected redemption is only 9,500 points, and each point counts for $1. So that's 9,500 points in total. The sales value at retail prices is 100,000. If you add up the total standalone value of the sales at retail prices as well as the points, we get a total of 109,500. Now, if $109,500 was calculated as 100%, then sales will be 100,000 divided by 109,500. It'll work out to 91.32%. So I'm just dividing 100,000 by 109,500. And likewise, the points will be worth 9,500 divided by 109,500, or 8.68% of the total. Now keep in mind our actual sales value was $100,000. So we have to allocate $100,000 in total. And so that what we do is we multiply the 100,000 by the percentage that we calculated for sales. And that works out to 91,324. And the points value is 8,676. And it's just a matter of rounding. So if I increase the decimal places, you'll see it exactly works out to that. Now, how do we record the journal entry? The sales are made on cash. So you want to debit cash for the $100,000. And you will credit sales revenue, 91,324, and we'll credit unearned points revenue for the $8,676. Keep in mind, cost of goods sold was 55% of the sales value. Now, it is possible to get a little bit confused. Yeah, we are recording sales revenue at $91,324, but you know what? The retail price value was 100,000. So our cost of goods sold, we're going to calculate with reference to what the sales was at retail value. That's 100,000. So 55% of that is our cost of goods sold. Okay, don't multiply 91,324 by the 55%. It should be calculated with reference to the retail price. Part C of the question asks if there would be any difference at all had we been following ASPE, and the answer is there would really be no difference. The treatment will be exactly the same under ASPE. Okay, moving to exercise 1311 and 1312. These two are related. They're basically based off the same piece of information, and they pertain to compensated absences. So compensated absences is when employees have are given paid time off. Now that paid time off could be for vacation days, right? So vacation days, companies are sometimes legally required to provide certain days of vacation to employees, or they could be on account of employee being sick, so that the companies do provide certain number of sick days to employees. Now, it is difficult for the company to predict when the employees will be taking their vacation. And sometimes, vacation days can be carried forward for a certain length of time. Sometimes they expire. Sick days would typically expire. Not all employees are going to claim their entitled number of sick days every year. So it becomes a bit difficult to predict exactly how it's going to play out. So some companies will come up with formulas to sort of estimate how much the entitlement is and how much of a liability they need to create in case the employees are entitled to a paid absence and they have not yet taken it. So coming to the facts provided in the question, Mustafa Limited began operations on Jan 2nd, 2019. Mustafa employs 9 individuals who work 8-hour days and are paid on an hourly basis. Each employee earns 10 paid vacation days and 6 paid 6 days annually. Vacation days may be taken after January 15th of the year following the year in which they are earned. So for the year 2019, the vacation days can only be taken in 2020. Sick days may be taken as soon as they are earned. Unused sick days accumulate. So keep in mind, employees get 6 paid sick days. So during 2019, each employee can take up to a maximum of 6 sick days, paid sick days. In case they only take 5, then the 1 day that they didn't use will just get carried forward to 2020 as per this company's policy. And then we're given some additional information. The actual hourly wage rate for 2019 and 2020. We're given the number of vacation days that were used by each employee. Now, the vacation days were 0 for 2019, and that makes sense because a vacation entitlement doesn't kick in until the year after. So after the employees have worked during 2019, then they become entitled to use their vacation days in 2020. So we can see that out of 10 paid vacation days, each employee has used 9 vacation days. Now, keep in mind, in real life, it will be a little bit messier. For purposes of exercises and examples, the textbook questions they tend to be a little simplified, right? So we're assuming that every employee took 9 vacation days in 2020. And then for as far as the number of sick days are concerned, each employee, each of the 9 employees that Mustafa has, used 4 days of sick leave in 2019, and then 5 days of sick leave in 2020 each. The company's chosen to accrue the cost of compensated absences at the rates of pay in effect during the period when they're earned, and to accrue sick pay when it is earned. For the purpose of this question, ignore any tax, CPP, and EI deductions when making payments to the employees. Okay. So part A of the question asks us to prepare journal entries relating to the vacation entitlement for the years 2019 and 2020. And then part B asks us to do the same thing for sick days. And part C then asks us to calculate the amounts of any liability that will be reported for the vacation pay and sick days for the balance sheets dated December 31st, 2019 and 2020. All right. So it's a good idea to start off with some calculations. So keep in mind the company has 9 employees, right? So for each of the years, you got 9 employees and they work 8-hour days. So each day that they work for 8 hours. And in the year 2019, the hourly rate was $20. And in 2020, the hourly rate was bumped up to $21. So what are the daily wages then for all the employees? 9 employees, 8 hours worked, 20 hours a day. So 9 multiplied by 8 multiplied by 20 works out to daily wages for all the employees together, 1,440. You do that math for 2020, it's 9 employees, 8 hours a day, $21 an hour, we get 1,512. Now, as far as the vacation wages payable liability is concerned, at the beginning of 2019, the company only started on Jan 2nd, 2019. So as far as the start of the year is concerned, there would not be any liability. For the year 2019, because the employees have worked, each employee, keep in mind, earns 10 paid vacation days. So 1,440 times 10, that would be the expense that the company records for the year 2019. And because none of the employees has taken any vacation yet, the liability balance at the end of 2019, or the beginning balance for 2020, if you will, is $14,400. And that would be our journal entry for 2019. You want to debit the expense, salaries and wages expense, and credit vacation wages payable, $14,400. Now, things change a little bit in 2020 because during 2020, employees actually went and took some paid leave, right? They took some paid leave and it was 9 days. Now, the employees took their vacation in 2020. And if they're taking their vacation in 2020, they'll be paid at the wage rate in effect on 2020. That should make sense, right? If I'm taking paid leave in the current year, I expect to be paid my salary that I'm entitled to in the current year. So I don't care that the salary, the vacation was earned in 2019, right? I mean, to me, I expect to be paid at the rate that I am being paid at the time of taking leave. So that is what would happen with these employees. They will get paid at the rate of $1,512 for 9 days. So vacation wages that we ended up paying is 1,512 times 9, $13,608. This is how much cash the company has paid to its employees. Now, what does that do? It depletes the vacation wages payable liability, right? The liability gets reduced from $14,400 by $13,608 to $792. Now, that's what the unadjusted balance of the vacation wages payable liability will be as of December 31st, 2020. Now, we want this balance to be actually how much? Well, each employee earns 10 paid vacation days. So, for 2020, there is an entitlement of 10 paid days where each day's payroll is $1,512. And we have 1 day's vacation that remains untaken, right, unused from 2019, and that had been calculated at $1,440. So if you multiply, right, if you multiply the 1,512 by 10 days and add the 1 day unused from 2019, which was calculated at 1,440, we get a total amount that the company requires, right? So the total amount that the company requires works out to, the required ending balance works out to $16,560. Now, what is that? It's basically 1,512 times 10 and add $1,440 for the 1 day's vacation that has not yet been taken for 2019. Now, our unadjusted balance is 792. We want the vacation wages payable liability to be 16,560. So how's that going to happen? To make it happen, we need to record an expense for the difference between these two amounts. And the difference between the two amounts is 15,768. So that's a plug for us, right? It's a plug amount that we calculate and use it for our journal entry. So what's our journal entry going to look like here? We are going to debit vacation wages payable for the amount that we paid, 13,608, credit cash, right? Just keep things simple. And then we're going to credit the vacation wages payable liability and debit salaries and wages expense for $15,768. Now, you could possibly have combined the entry here as well, just make it a little bit more difficult for people to follow, but doable certainly. What we would then have is debit salaries and wages payable 15,768, credit the cash 13,608, and then whatever is the difference, that's how much the vacation wages payable account will be credited for. And that would just be the difference of 16,560 as opposed to 14,400. And you can try that out at your end. Now, looking at part B for the calculations for sick days, it's very similar to what we just did. Just keep in mind that employees are allowed 6 sick days instead of 10 vacation days. So the calculation of the daily wages is the same. 14,440 was the total daily payroll for this company in 2019, and $1,512 was the payroll in 2020. Now, starting with the sick pay wages account, there would have been $0 balance because the company didn't exist on Jan 1st, 2019. It only began operations on Jan 2nd. Now, the expense for the year 2019 would be calculated $1,440 times 6 days that the employees are entitled. And that gives us 8,640. Now, guess what? The employees actually did take some sick days in 2019. It's 4 days. So we would have paid our employees for 4 days of sick leave. So 1,440 times 4, we've already paid in 2019, $5,760. So the balance that remains in the sick pay wages payable, the liability, will be 8,640, the expense that we recorded, minus 5,760, the amount that we paid out, and that gives us $2,880. So for the year 2019, those would be our journal entries. Debit the salary and wages expense, 8,640, credit cash, 5,760, credit the sick pay wages payable, 2,880. Now you could have split this up into 2 journal entries, If you liked, what you would then do is debit the salaries and wages expense for 8,640, credit the sick pay wages for 8,640. And then for the payment, you want to debit the sick pay wages payable account and credit cash for 5,760. All right, so either combine them together or show them as two separate journal entries. It's your choice. Now, what happens in 2020? In 2020, the employees took 5, right? They took 5 sick days. All right. Now, the employees will be paid for the 5 sick days taken at the pay rate in effect in 2020. So that's $1,512. So multiply 1,512 by 5 days each, you're getting $7,560. Now keep in mind, the sick days actually accumulate. So what happens is, remember there were 2 days unused per employee from 2019. So first of all, in 2020, those 2 days unused will have been used up. So out of the 5 days of sick days that the employees took, 2 days were the unused sick days from 2019. So basically that means only 3 days of the sick day entitlement has been taken for 2020. And that means we need our ending balance for the sick pay wages payable to be calculated for 3 days at the pay rate in effect for 2020. And that's 1,512. So that's what we need. We need 1,512 times basically 3. And that works out to the amount that we require for our ending liability balance to be $4,536. Now to make this happen, you can calculate the plug amount for the expense. We began with 2,880. We want to end up with 4,536 as our sick pay wages payable liability. We have paid $7,560 in cash to employees that did take their sick days in 2020. So the difference then works out to $9,216. And that, my friends, will be the amount that we record as expense. So I showed you in two parts here. So we could have either combined the two numbers up like 2019 or show them in 2 parts, 2 journal entries like I showed here, 2020. It's entirely your choice. All right, part C is what amount gets reported as the liability, and it's pretty easy to go pick. We've already done the math. So balance for the liability at the end of 2019 for the vacation wages payable was $14,400. And the balance at the end of 2020 is $16,560. So those are the amounts that the company will report for liability. And for the sick pay wages, the amounts are $2,880 and $4,536 respectively. And that's what we have. Okay, now part D of the question says, how would your answers to part B and C change if the entitlement to sick days did not accumulate? So if sick days don't accumulate, then basically we'll just record the expense for the amount that we paid, right? We're not going to accrue any other amount, right? So that is the only difference that will happen. If sick days don't accumulate, we're just going to record the expense as the sick days are claimed. So that's all that we'll do. There will be no liability reported for sick pay wages payable. Okay, now part E of the question is basically exercise 1312. I combined the two questions into one. And what this one says is if Mustafa had chosen not to recognize paid sick leave until it's used, so we're not going to accrue anything basically, and has chosen to accrue vacation time at expected future rates of pay without resorting to any discounting. And that's just like, how do we calculate a PV on top? And Mustafa uses the following projected rates to accrue vacation time. So for the year 2019, instead of using the wage rate in 2019, which was $20, Mustafa will use an expected or projected pay rate of $20.75. Remember that the vacation that is earned in 2019 can only be used in 2020. The vacation that is earned in 2020 can only be used in 2021, and so on. So that's what Mustafa is doing. In 2019, Mustafa projected that the average pay rate would be $20.75. It wasn't. The actual rate in 2020 came out to be $21. That's okay. The company wouldn't know how much the wage rate will work out to in 2020, right? It's possible that there are negotiations with employees and so on. So don't get bothered by that. The company used $20.75 to accrue its wages. So during 2019, for the year 2020, the company used a projected hourly wage rate of $20.75. So multiply 9 times 8 times 20.75, the rate that the company uses to accrue the vacation, right? Record the expense for the vacation wages is $1,494. The actual daily wages for the year 2019, keep in mind from part A were only 1,440. So what does that mean in terms of our T account? We start with a $0 balance. We record an expense calculated at $1,494 per day, and employees get 10 vacation days. So that's $14,940. So the balance at the end of 2019 will be $14,940. And the journal entry to record that will be debit salaries and wages expense, credit vacation wages payable, $14,940. Now, 2020 is when things get a little bit interesting. So what are we doing there? 2020, when we accrue the wages, we're going to use the dollar amount that the company expects to pay in 2021, and that's $21.60. So again, still the same, 9 employees working 8 hours a day, paid at the rate of $21.60, works out to $1,555. However, remember that the actual daily wages in 2020 were $1,512 that we had calculated earlier. So in 2020, each employee took 9 vacation days. So again, this is something that sometimes can be a bit confusing to people. So try and understand it. When the employees are taking days off, they don't have to come to work, but they are getting paid. Now they will be paid at their wage rate in effect at the time that they took the time off. And that's $21. So based on that, so we're actually going to be paying these employees at the rate of $1,512 per day. So 9 paid leaves at $1,512 each. The cash that the company paid to the employees was $13,608, which is exactly the same that we had up here, $13,608. Now, what's going to be different is how we then calculate the ending balance and so on. So first of all, looking at the vacation wages here. 14,940 was the liability. We've already paid out 13,608. So we get a unadjusted balance on December 31st, 2020, amounting to $1,332. Now, the balance that the company requires at the end of 2020 is for 10 days vacation entitlement, calculated using 1,555. Remember, the company accrues its vacation amounts using the projected pay rate. So for 2020, the 10 days that the employees have earned as vacation time needs to be accrued using 1,555. And the 1 day that is unused from 2019 needs to be carried at 1,494. So if you do the math there, $1,555 times 10 days, that's for 2020. And then 1,494 times 1 day unused from 2019, our required ending balance for the vacation wages payable liability is $17,046. Since we already have $1,332 already in that liability, the difference is what we must accrue as the expense for the year 2020. So this amount also is a plug that we calculate, and we go ahead and record our journal entries for 2020 like this. And we were told that the company is not accruing for sick leave. So basically what that means is we just record the expense for the amount of sick leave that employees actually take, right? So we are not accruing for any amount that the employees or any number of sick days that the employees did not use in any year. So during 2019, the employees took 4 sick days each. So 1,440 times 4 gives 5,760. And then in 2020, the employees took 5 sick days each, and that's $7,560. And in terms of what is represented on the balance sheet, we'll only have a liability for vacation wages, and that will be for the year 2019, 14,940. And for the year 2020, the amount is going to be $17,046. That's coming from the T account that we have here. All right, the last example. And what we're going to be looking at here is contingent liability. So if you have contingencies, what do we do? And how do we treat contingencies under ASPE as opposed to IFRS? So 1329, there are 4 independent situations. So situation 1, in 2020, Sugar Post Inc. became involved in a tax dispute with the Canada Revenue Agency. Sugar Post tax lawyers have told management that the company will likely lose this dispute. They also believe that Sugar Post will have to pay the Receiver General for Canada between $900,000 and $1.4 million. After the 2020 financial statements were issued, the case was settled with the Canada Revenue Agency for $1.2 million. Now, there's a few things to look at. The instructions required is what amount, if any, should be reported as a liability for this contingency as at December 31st, 2020, assuming that the company follows ASPE. So under ASPE, we record a contingent loss. Okay, so terminology, there's a terminology difference between IFRS and ASPE. I'll talk about IFRS in a bit, but under ASPE, this will be called a contingent loss is recorded if the chance of occurrence of the future event is high. So what future event are we talking about? We're talking about the company being found or basically losing the dispute with CRA, right? And the lawyers for the company have said, well, we are likely going to lose this dispute. So the chance of that future event is high. Sugar Post lawyers have already told management that the company will likely lose the dispute. So contingent loss must be recorded. Now, how do you record the contingent loss? You debit contingent loss, credit a contingent liability, right? That's basically what you do. Or you can use different names, right? You can use maybe litigation loss, for the debit, and set up a litigation liability or provision for tax liability, etc. Right? Different names can be used. Now, how much? If you're recording a loss, how much do we record the loss at? So ASPE guidance says if the amount of loss is presented as a range, and that's the case here, right? Between 900,000 and 1.4 million. So that's a range for us. So if the amount of loss is presented as a range, the amount that's a better estimate than others should be used to record the loss. So if the lawyers had said, yeah, it could be anywhere between 900,000 to 1.4 million, but we think maybe 1.1 million is most likely, well, then we would have used 1.1 million. But that's not clear, right? If this amount is not clear, which of the two amounts is the best reflector, well, then under ASPE, we use the minimum amount. So what's the minimum? It's 900,000. So you use 900,000 to record the loss. And then we disclose the fact that the amount could be as high as 1.4 million. So that's what's done in Sugar Post case. We have a range of 900,000 to 1.4 million with no single amount being a better estimate of the loss. The company will report or company will accrue 900,000 and disclose the rest. Now there's something else that happened. The lawsuit was actually settled for $1.2 million. So this is called a subsequent event, an event that occurs after the financial year end. So when it comes to subsequent events, some of the subsequent events need adjustments, right? So we kind of need to adjust our balance sheet amounts if the subsequent event occurs before a certain cutoff date. So the cutoff date under ASPE is the date the financial statements are completed. All right. And that happens when sort of the financial statements have been reviewed and approved in principle by the board of directors. The auditors have done their job, etc. Right. So without making it too complicated, if the settlement with CRA had happened before the financial statements for 2020 were completed, then for the balance sheet dated December 31st, 2020, Sugar Post would need to have reported $1.2 million, right? But that didn't really happen because in Sugar Post's case, the settlement with CRA happened after the financial statements were issued. So as such, for the balance sheet, it would be a contingent liability of 900,000 that gets reported. Now, what would happen if we were following IFRS? So the same facts, if we were following IFRS, then under IFRS, the terminology is, it's not contingent loss. The terminology used under IFRS is a provision, okay? Under IFRS, a contingent liability is not recorded, but the terminology that we use in IFRS is a provision. So provision is recognized if the entity has a liability. So keep in mind the definition of a liability is it's a result of past occurrences, right? A past event, and it is likely that it'll result in an outflow of resources, et cetera, right? So we looked at the definition during class. So if the company's got a liability and a reliable estimate can be made for the amount of the obligation. So if these criteria are met, then a provision should be recorded. So in Sugar Post's case, clearly, as the lawyers have come and said, well, it's likely we're going to lose the dispute, and the amount payable is between 900,000 and 1.2 million. We need to record a provision. The amount should be the most likely amount. Okay, now that is kind of similar to what ASPE is saying. Pick up the most likely amount. Now, if you can't figure that out, right, if no single amount is more likely than the others, then the midpoint of the range is used, right? So we'll end up using $1,050,000, which is 900,000 plus the 1.2 million divided by 2. Okay. Now, subsequent events. IFRS says financial statements must be adjusted for subsequent events that occur between the financial statement date, which is December 31st, 2020, and the date the financial statements are authorized for issue. The authorized for issue is tends to be a little bit later than the board, right? So the board members kind of have to sign off and so on. So that can happen a little bit after. So in Sugar Post's case, the settlement with CRA occurred after the financial statements were issued. So that's clearly, you can't issue the financial statements until they are authorized. Again, clearly happened after the fact. So the 2020 financial statements will report a litigation loss with a provision of $1,050,000. Situation number 2, they're all independent situations. So here we have a different company. Toward the end of Sully Corp's 2020 fiscal year, employer union talks broke off with the wage rates for the upcoming 2 years still unresolved. Just before the new year, however, a contract was signed that gave employees a 5% increase in their hourly wage effective January 1st, 2021. Sully had spent 1.2 million in wages on this group of workers in 2020. We're asked to prepare the entry, if any, that the company should make at December 31st, 2020. Now, this is an interesting one. The 5% increase, that has been negotiated. When does it kick in? It only kicks in on Jan 1st, 2021. So as of December 31st, 2020, the company doesn't have any extra liability. So there's no adjusting entry needed here because the wage rate increase is effective from Jan 1st, 2021. And this was the case, doesn't matter if it's IFRS or ASPE. Situation number 3, on October 1st, 2020, the Provincial Environmental Ministry identified Jackhammer Chemical Inc. as a potentially responsible party in a chemical spill. And that's usually bad news. When you're identified as a potentially responsible party, it means you're likely going to get fined and so on. So Jackhammer's management, along with legal counsel, have concluded that it's likely Jackhammer will be found responsible for damages. So what typically happens is they carry out an investigation, and if the provincial environmental ministry's inspectors find that the company was involved, maybe they spilled some chemicals into the water or were negligent in storing certain chemicals, et cetera, well, then they will be fined and they'll have to incur costs. So they have concluded that Jackhammer will be found responsible for damages, and a reasonable estimate of these damages is $5 million. Of course, $5 million is a lot of money. Right now, before we quickly hasten to say, oh yeah, we need to accrue $5 million, keep in mind, companies will often have insurance coverage. So Jackhammer's insurance policy of $9 million has a clause requiring a deductible of $500,000. So like I'm assuming here that the insurance policy relates to any kind of liability related with environmental spills. So if that is the case, then yeah, $5 million is a big fine to pay, but the insurance claim can cover most of that fine. Jackhammer will only be on the hook for the deductible amount of $500,000. That's how much Jackhammer will need to pay out of pocket, right? So that is basically the situation under situation 3. So again, under ASPE, a contingent loss is recorded if the chance of occurrence of the future event is high. Jack Chemicals has been identified as a potentially irresponsible party. The lawyers believe the company will be found responsible for damages, so a contingent loss needs to be recorded. Now, because Jackhammer already has an insurance policy for an amount that exceeds the $5 million that is likely to be paid, the company only needs to accrue the amount it will have to pay under the policy deductible, and that's $500,000. And the treatment's the same under IFRS. Under IFRS, we would record a provision for $500,000. The last situation is Etheridge has a manufacturing plant in a foreign country that was destroyed in a civil war. It's not certain who will compensate Etheridge for this destruction, but Etheridge has been assured by that particular country's government officials that it will receive a definite amount for this plant. The compensation amount will be less than the plant's fair value, but more than its carrying amount. So how should the contingency be reported on the financial statement? So keep in mind, although the amount of compensation will be less than the fair value, the fact that it will be more than the carrying amount of the plant and equipment means that from an accounting point of view, the amount that we'll get will be, since it's more than the carrying amount, when we record that fact in our books, there would be a gain on disposal. So the question here is, should Etheridge record a contingent gain on the destruction of its plant? And the answer under both IFRS and ASPE is a resounding no. We cannot accrue contingent gains. So terminology for ASPE is contingent loss or contingent gain. So contingent gains can't be accrued under in the financial statements, but we can disclose if an asset has been acquired as of the date of financial statements. So if there was some kind of a letter that we got from the officials, then we may disclose the fact, but we are not able to accrue it. And under IFRS, the terminology is a contingent asset, so we can't recognize a contingent asset. However, again, if the inflow of economic resources is probable, a contingent asset may be disclosed. So we can't recognize it. To recognize something means to record on our books. That can't be done, but yes, we can disclose. All right. That, my friends, brings us to an end to all the additional examples for chapter 13. I look forward to seeing you folks in class on Thursday. And yeah, do ask whatever questions come to your mind. Bye.